Welcome to another episode of Taking Stock for the week ending the 24th of October 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to bring to your Think Share Market. How are you, Matt? Hope you're fine today.
Yeah, I'm well, thanks, Ken. I haven't been on taking stock for quite a while now, so it's great to be joining you again.
Yeah, I'm sure you're still pretty busy with the AGM season coming through with all these announcements. But as always, the information we share today is of a generic nature and doesn't take into account your personal situation. Remember, shares are volatile and any past performance figures aren't a reliable indicator of future performance. Well, Matt, global markets were quite volatile this week with sharp swings, especially across commodities. The highlight came from gold, which fell more than 6% in just 2 days, its deepest drop since 2013. And the fall followed a pause in central bank buying and widespread profit taking after an extended rally to record highs.
Well, I wouldn't call it a highlight, more of a low light, given the very large exposure that we have to gold stocks, particularly in our Lincoln Australian Growth Fund. So the development caught our attention, obviously, especially around risk management of our portfolios. And meanwhile, the energy sector found some support overnight after the US imposed sanctions on two of Russia's largest oil companies. Well, that came as a response to obviously renewed military escalation. The move pushed oil prices higher as traders priced in tighter global supply.
Yeah, that's why diversification is necessary, not in gold, but in oil here. At the same time, Woodside Energy, they rose after announcing strong quarterly updates and also a strategic partnership with US gas infrastructure leader Williams, a deal that strengthens its global LNG network, but we'll talk more on that later.
And the media sector faced renewed pressure with Netflix falling sharply after reporting an unexpected tax charge in Brazil, which spooked investors and sparked a broader sell-off in growth stocks.
Yeah, but let's talk about Australia, Matt. Optimism around the US Australian critical minerals deal that initially boosted mining and rare earth stocks, though the rally faded as investors took profits later in the week. But still, AGM season so far has been encouraging with earnings revisions for the market up about 3% since reporting season. And not surprisingly, that's been driven by upgraded commodity price forecasts, especially within the mining and gold sectors. But let's now move on to some star stock highlights for the week, starting with wealth platform provider HUB24. HUB's first quarter update that beat expectations with net inflows up 28% year on year. And this was ahead of consensus forecasts driven by advisor growth, rising funds under administration, and also strong market movements.
Yeah, exactly, Keen. Hub's inflows momentum remains one of the best in the wealth platform space alongside net wealth. Total funds under administration have now reached 146.5 billion, up 30% on last year. All the growth was organic, supported by advisor engagement across its Engage and Private Invest platforms, and this has contributed to positive earnings revisions with ROE forecast to rise to 23% this financial year.
And staying within the sector, Matt, Praemium, PPS the code, they also delivered a positive quarterly update as well, in line with expectations. Funds under administration, that rose 13%, and that was helped by new inflows and also the wind down of legacy systems like OneView. But Praemium trades at a much lower valuation than Hub. Why is that, Matt?
Well, it mainly comes down to business mix and profitability. Praemium caters more to high net worth clients with complex portfolios, which means higher costs and lower scalability. Hub, on the other hand, benefits from a larger retail advisor base and better operating leverage with higher profit margins, hence the higher PE multiple of about 73 times compared to 25 times for Praemium. But still, Praemium's new Spectrum platform should improve margins over time.
Yeah, and we've seen the share price actually react quite positively over the week. But turning to retail now, Super Retail Group, SUL is the code, they reported like-for-like sales growth of around 2.6% across its brands for the first 16 weeks of financial year 26. That's roughly in line with expectations. And Macpac and Rebel, they continue to perform well here, while BCF, it lagged weekly though. Following its recent share price decline, though, on the back of the sacking of its CEO, Matt, the stock does appear inexpensive at these levels, though.
It does, and I was a bit surprised that they're actually sold off yesterday. But that's how the markets behave sometimes. And in energy, Woodside released a solid quarterly update with production a touch ahead of expectations, and the result was helped by steady performance at its Pluto and Northwest Shelf projects, plus early contributions from its new Sangomar field in Senegal. Management also raised full year production guidance pleasingly to between 192 and 197 million barrels, up from around 190 million previously announced.
Yeah, commodity prices, they keep on changing, don't they? And as a result, we're seeing positive revisions starting to flow through from that production upgrade. But Woodside also gave a reassuring update on its major growth projects. Both Scarborough and also Pluto Train 2, they are now close to completion, with first gas expected by mid-2026. And the company's new Louisiana LNG partnership with US energy group Williams, that adds another dimension, giving Woodside a stronger foothold in the American gas market while also sharing project costs and reducing risks. And these projects should contribute to earnings recovery from financial year 27 onwards.
And Kien, I've noticed you've removed Treasury wines from stock doctor coverage during the week.
Yeah, Matt, despite its global brand strength, ongoing challenges, including softer luxury wine demand in China, distribution issues in the US, leadership transition risks, and also rising short interest, the earnings outlook does look quite uncertain. While the stock appears undervalued, though, the near term growth outlook is negative, so it no longer meets our high conviction growth criteria.
And for those wanting more detail, you can read full commentary on the platform. And with AGM updates coming through thick and fast, make sure you check out our corporate calendar to stay across upcoming announcements and key company updates.
In Under the Microscope this week, we're taking a look at Codan. CDA is the code, a long-term favorite among our Stargrowth stock portfolio. Now, Codan designs and manufactures metals detection and communications technology. So they serve in the defense, mining, and also consumer markets across more than 150 countries. And they're best known for their Minelab detectors, but its communications business now represents 52% of its total earnings.
And Codan's first quarter results were better than expected, which was very pleasing. Both divisions posted strong gains supported by new defense contracts, firm gold prices driving detector demand in Africa, and rising orders from Corgworks, the US tactical communications business acquired last year. Management said quarterly revenue was 16% above last year's average, signalling a very strong start to FY26.
Yeah, and that positive update should lead to further upward earnings revisions, with return on equity forecast to climb to around 24% this year. But looking ahead, the growth outlook remains strong. You've got defense budgets, they're expanding, gold exploration is quite steady, and Codan's global reach spanning Africa, the US, and also now the Middle East, that provides a natural hedge against regional risks.
Financial health is obviously very strong. The balance sheet is debt-free and cash flow is very solid, giving it plenty of financial flexibility. But that said, the share price has already doubled over the past year.
Yeah, and for those holding meaningful gains, though, trimming exposures here may be prudent, although not surprisingly, the stock does trade at a premium to fair value with its forward PE multiple at around 48 times. But Codan's mix of innovation, strong leadership, and also exposure to both gold and defense should help drive double-digit growth in the years ahead. And with the gold prices swinging sharply this week, down more than 6% from their record highs, many investors are wondering, is this a short-term correction or the start of a longer-term bear market in gold?
Look, we never know the answer to these questions, but look, we're seeing it as a healthy correction, not the start of any major downturn, or certainly there's no fundamental reason why there should be. Gold has surged obviously over 50% year to date, driven by global central bank buying, continued inflation concerns, and expectations of further rate cuts. After such a steep rally, some cooling was obviously overdue.
Yeah, Matt, it was quite interesting. The sell-off was reportedly triggered by gold producers locking in their gold prices via hedging. And the hedge fund saw this as a sign that gold has run too hard, which led them to sell. And then that cascaded into traders getting stopped out of their leverage bets. Then it all spiraled out of control with heavy profit taking leading to a volatility spike.
Yeah, it became a very crowded and hot trade, didn't it? And when you start talking about leverage bets and what have you, these things oftentimes cascade into these mini sell-offs like we saw on Tuesday. But longer term, the fundamental drivers for gold do remain in place. Central banks are still buying. Interest rates, as we see it, are going to continue to move lower, and geopolitical tensions are only intensifying. So we will see this as a consolidation phase with an ongoing bull market. History does show that some pullbacks in 2013, 2020, and 2022 have often became very good buying opportunities.
Yeah, and from a overall portfolio perspective, gold still offers valuable diversification and protection against inflation and also currency risk. But for those who are more risk averse, focusing on those larger, lower cost producers like Newmont, Northern Star, Evolution may offer a smoother ride.
It's all a very good reminder that even in a bull market, corrections are very normal. And for patient investors, sometimes they do open up the door for opportunity.
Yeah, wise words, Matt. But that's all we have time for today. And again, thank you for coming on board and sharing your insights.
My pleasure as always, Kien. And if you'd like to dive deeper into any of the stocks that we've mentioned today, feel free to join us for Lincoln Live on Monday morning.
Thanks. And before we wrap up, just a quick reminder, if you have friends or family who could benefit from Stock Doctor, feel free to share the knowledge. Our growth comes from members like you, and we truly appreciate your ongoing support. Until next time, stay safe, stay invested, and have a prosperous week ahead.